Somewhere out there is a market you've probably never opened a browser tab for, never checked on your phone, never even heard mentioned at a dinner party. And yet it just decided what you're paying on your mortgage this month. It decided what your car loan costs. It even had a hand in whether your job feels secure right now. We're talking about a market worth somewhere in the neighborhood of $140+ trillion, and almost nobody watches it. Personal anecdote placeholder: a moment when you got a mortgage/loan quote and were shocked by the rate, or when you first learned bonds existed. Back in 2022, this same market quietly wiped out roughly a sixth of the safe portion of a lot of people's retirement accounts in a single year. Not the risky stock portion, the safe portion. The part people were told couldn't really hurt them. By the end of this video, you'll understand exactly how that happened, and you'll be able to look at any headline about the 10-year yield and actually know what it means for your wallet. Section 1. What a bond actually is. Let's strip this down to the studs, because Wall Street loves making simple things sound complicated. A bond is just a loan. That's it. Somebody needs cash. Could be a government, a corporation, a city building a new highway. And instead of walking into a bank, they walk into the bond market and borrow directly from investors like you. You hand over a set amount of money, called the principal. In exchange, you get two promises: a fixed interest payment on a regular schedule, that's the coupon, and your original money back on a specific future date, the maturity date. Lend me $1,000, I'll pay you interest every year, and on this date years from now, you get your $1,000 back. That's the whole contract, dressed up in a fancier vocabulary. What makes this market so enormous isn't complexity, it's scale. The single biggest borrower on the planet is the US government. Depending on when you check, the national debt sits somewhere north of $38 to $39 trillion. That figure is so large, your brain basically stops processing it. So here's a number that hits differently. Just the interest on that debt, not the debt itself, just the yearly interest bill, runs somewhere around $1 trillion a year. That's roughly several billion dollars a day, purely in interest payments. For context, that's now bumping up against, and by some measures, exceeding, what the government spends on the military. And every dollar of it eventually traces back to taxpayers, because the rate the government pays is set in the exact same marketplace that sets your mortgage rate. Section 2. The one rule that explains everything. If you remember nothing else from this video, remember this single rule. When interest rates go up, the price of existing bonds goes down. When rates go down, existing bond prices go up, always. No exceptions. Here's why, using round numbers. Say you buy a $1,000 bond paying 3% interest. That's $30 a year. A little while later, the government starts issuing brand new bonds paying 5%, $50 a year on the same $1,000. Now you want to sell your old bond. Why would anyone pay full price for something paying $30 when they could buy a fresh one paying $50? They wouldn't. So the only way to actually sell your bond is to drop the price, enough that your fixed $30 payment now looks competitive against the new 5% bonds. That price ends up somewhere around $600. Nothing about your bond's actual payments changed. It still pays $30 a year. It'll still return $1,000 at maturity. But on paper, today, it's worth a lot less than what you paid. Hold that idea, because pretty much every disaster in the rest of this video is just that same seesaw playing out at a massive scale. Section 3. The one number that runs your life. Out of the entire bond universe, there's one instrument that matters more than all the others combined: the 10-year US Treasury bond. Right now, it's yielding somewhere around 4.5%, give or take. Here's why your bank cares so much about it. When a lender decides what rate to offer you on a 30-year mortgage, they're not pulling a number out of thin air. They're looking at that 10-year Treasury and asking a simple question: why would I lend money to a household for 3 decades when I could lend it to the US government, essentially risk-free for 10 years at roughly 4.5%? The honest answer is they wouldn't unless you pay them extra. So banks typically take the 10-year yield and tack on roughly 2 percentage points to cover the added risk that comes with lending to an actual person. Job loss, illness, missed payments, all of it. Add that spread to a 10-year yield of about 4.5%, and you land somewhere close to the national average 30-year mortgage rate today, which tends to hover around 6.5%. Let's make this concrete. Anecdote placeholder: introduce a hypothetical homebuyer or reference someone in your circle currently house hunting. Let's call her Maya. Maya's taking out a $400,000 30-year fixed mortgage at roughly 6.5%. Her monthly payment lands somewhere around $2,530. Now watch what happens with a move that the bond market can make in a single ordinary trading week. If the 10-year yield ticks up by just half a percentage point, Maya's mortgage rate rises to roughly 7%. Her new monthly payment climbs to somewhere around $2,660, about $130 more every single month for 30 straight years. Add that up over the life of the loan, and that one modest bond market move costs Maya somewhere in the ballpark of $47,000. Bump that move up to a full percentage point. Still nothing dramatic by bond market standards. And Maya's rate pushes past 7.5%. Her payment jumps by roughly $270 a month, translating into close to $95,000 extra over the full loan term. That's a six-figure bill, generated by a market Maya has never opened, never checked, and probably couldn't name if you asked her. And the swings can be brutal. Back in early 2021, 30-year mortgage rates touched historic lows near 2.6%. On that same $400,000 loan, Maya's payment would have been roughly $1,600 a month. Fast forward to late 2023, when rates spiked close to 7.8%, and that identical loan would run her nearly $2,900 a month. Same house, same buyer, same loan amount, a difference of over $1,200 a month, or something in the range of $450,000 across the life of the mortgage. The bond market handed her that bill without ever sending an invoice. Section 4. When the safe part of your portfolio wasn't safe. For generations, the standard retirement advice was, as you get older, shift out of stocks and into bonds. Stocks grow your money, bonds protect it. The classic 60-40 portfolio, 60% stocks, 40% bonds, was sold as the responsible, conservative choice. Bonds were supposedly the seatbelt. Then 2022 happened. The Federal Reserve raised interest rates faster than it had in roughly 4 decades, taking the benchmark rate from near zero to over 4% in under a year. Apply the rule from Section 2. Rates spike, bond prices fall. The broad U.S. bond market had its worst calendar year on record in data stretching back to the mid-1970s, dropping somewhere around 13%. Meanwhile, the S&P 500 fell about 18% that same year. Put those together in a standard 60-40 mix, and the safe portfolio still lost close to 16%. The seatbelt didn't save anyone. It was buckled into the same crash. And the longer dated the bond, the worse it got. Intermediate-term Treasury funds, the kind sitting inside most target date retirement funds, dropped somewhere around 10 to 11%, reportedly their worst showing in roughly a century of data. Longer-dated zero-coupon treasuries, about as safe-sounding an asset as exists, fell close to 40%. One widely cited academic analysis of historical returns found that long-duration U.S. bonds hadn't had a year that bad since the 1750s, before the country existed. There's a single number that explains why some bond funds got crushed while others barely flinched. It's sitting right there on every bond fund's fact sheet, and almost nobody reads it. Duration roughly estimates how much a fund's value drops for every 1 point rise in interest rates. Anecdote placeholder: someone you know nearing retirement, or a family member's experience checking their 401k in 2022. Picture a retiree with $500,000 parked in what she believes is a conservative bond fund. If that fund has a duration around 6, pretty typical for a broad bond index, a 1-point rate increase costs her somewhere around $30,000. If instead, she's in a long-dated Treasury fund with a duration closer to 17, that same 1-point move costs her closer to $85,000. Same $500,000, same rate move, a gap of roughly $55,000, depending entirely on a number she probably never looked at. One more wrinkle worth knowing. If you own an individual bond and hold it until it matures, none of this really touches you. The price wobbles along the way, but you collect your coupons and get your principal back regardless. A bond fund, though, never matures. It's repriced daily, forever. And losses like 2022's don't just quietly disappear when the calendar flips. Section 5. Reading the market's own warning signs. Government bonds are treated as the safest asset on earth because the US government can print dollars to cover dollar debts. Companies can't do that. They can go bankrupt. So corporate bonds have to pay investors extra to compensate for that added risk. The gap between safe government yield and riskier corporate yield is called the high yield spread. And when it widens, it's often the bond market quietly signaling that it expects trouble. Layoffs, defaults, a slowing economy, sometimes well before that shows up in official economic data. The reverse happens during a genuine scare. When investors get nervous, a banking wobble, a geopolitical shock, fear of recession, money tends to rush out of stocks and corporate debt and into US Treasuries, a move often called a flight to quality that pushes Treasury prices up and yields down, sometimes within hours. This is also part of why stocks and bonds have historically tended to move in opposite directions, which is exactly what made the 60-40 portfolio work reasonably well for decades. The reason 2022 broke that pattern is that the sell-off itself was caused by rising rates, and rising rates hurt stocks and bonds at the same time. The hedge failed because the thing being hedged against became the thing doing the damage. Then there's the yield curve, arguably the single best recession predictor that exists, and it's sitting in plain sight. It's just a chart plotting Treasury yields across every maturity, from a few months out to 30 years. Normally, it slopes upward. Longer loans demand higher compensation because more can go wrong over more time. Occasionally, though, it flips. Short-term yields rise above long-term ones, and inversion. When that happens, the bond market is essentially betting that the Fed will be forced to cut rates soon because the economy is slowing. Research from Federal Reserve economists has found that essentially every US recession going back to the mid-1950s was preceded by one of these inversions. That's an extraordinary track record for something so few people actually watch. Section 6. The boring money sitting in your bank. Here's a gap that costs ordinary savers real money every year. The nationwide average savings account, per FDIC data, pays somewhere around 1/3%, practically nothing. Meanwhile, short-term Treasury bills are often yielding somewhere in the 3.5 to 4% range, and top high-yield savings accounts land in a similar neighborhood. All three options are effectively just as safe. Treasuries are backed by the US government, and FDIC-insured accounts are covered up to $250,000 per institution. Same safety, wildly different payout, purely because of where you park the cash. Back to Maya. Say she also keeps $50,000 sitting in a standard bank savings account, earning that roughly 0.4%. That's earning her something like $190 a year. Move that same $50,000 into short-term treasuries, yielding closer to 3.7%, and she'd collect closer to $1,800 a year, nearly 10 times as much, on identical principle with comparable safety. Leave it parked at the bank for 5 years instead, and she's quietly giving up somewhere around $8,000 in interest she didn't have to lose. And depending on your state, T-bill interest often skips state income tax entirely, which widens that gap even further. Closing takeaway. So here's the practical version of everything we just covered. If any part of your retirement savings sits in bond funds, go find the duration number on the fact sheet. Anything north of 7 means that fund will move meaningfully when rates shift. Anything above 15, and it's going to behave a lot more like a volatile stock than the seatbelt it was marketed as. If inflation specifically worries you, Series 1 savings bonds through the Treasury adjust their rate with inflation, though there are annual purchase limits worth knowing about. And the 10-year Treasury yield itself? It takes about 5 seconds to look up. When it climbs, mortgages and car loans and business borrowing tend to climb with it. When it drops sharply, the bond market is usually bracing for a slowdown. It's about as close as the economy gets to a check engine light. And now you actually know how to read it. I hope this video was helpful for you. If you find this channel helpful, then please do hit the subscribe button and turn on the notification to get notified every time when I upload a new video.